You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Mike, off mic, we were saying that it's been quite an interesting week so far.
Yeah, it has. Well, we're doing this interview on Thursday, and the market is down today. And one thing interesting about the stock market is really it hasn't done much this year. I was just looking at a chart, and it's kind of funny because around the 1st of March, I really did a lot of selling in my own account. I actually went to cash for a week or two, and it just I'm not in cash now. I do own some stuff, but I made a bunch of changes and told people to be very, very careful. And the market, the U.S. stock market actually made a new high a couple weeks ago, but despite that, it's actually below where it was when I was telling people to get out of it. So it's just not really doing anything, but going sideways all year. And then today it's off the highs. And one thing that's kind of curious is if you look in March, we had a breakout to new highs then a breakout to new highs in May. And the stocks that went up the most during those couple of days that the market had those two separate temporary surges, they just kind of popped up and then fizzled out. So in March, it was a bunch of biotech stocks that were hot for a couple of weeks. Then they just, faded away and lost leadership. And this time it was semiconductor stocks as a whole. And it's kind of curious because a lot of times once you get to the end of a bull market, you'll see a couple stocks that just continue higher and higher and higher at the end and kind of help lead the market averages higher. And this year that hasn't really been happening in the sense that there's just a few stocks that, are going up nonstop. Instead, it just seems to be these temporary little momentum surges and different things that just kind of come and go. And if you watch the television, CNBC and some of these financial channels, what they tend to do is focus every day on these little temporary hot, sad things that they're just not sustainable or they haven't been. And I think we're really approaching the end of the bull market here, and before the year's over, we'll be in another bear market. Things I'm looking though to be able to say that's happening, because I'm not trying to say these things like I'm predicting the future, like I'm clairvoyant or have a crystal ball that's always right or something. But instead, I'm looking for things that will show me that we're really in a bear market, and the main indicator for that is going to be the internals of the stock market really deteriorating and declining. So you'll have things like the advanced decline line no longer go up, even though the market is, and the number of stocks above the 200-day moving averages being more below them than above them, and being worse. And I use something called TC2000 to analyze the sectors of the market individually. It breaks it up into about a little over 230, and what happens as you go into a bear market is the same thing. Most sectors will already be below their 200-day moving averages. So for all this to happen, what we will need to see occur is a pullback in the stock market that really smashes these internal indicators, and then a bounce afterwards where these things don't come back that well. So right now, the market has fallen a couple days off the high, and some of these indicators are really already starting to deteriorate and decline. And I'm a little concerned if the market averages were to continue lower this month. Let's say the S&P 500 goes below 2050 or 2044. 2044 is where its 200-day moving averages. If it gets down to there, lot of sectors more sectors will be below that than above it, and that will start to look troubling. So, people have been very excited about the stock market. We've seen it have these temporary surges and it just fizzle out, and now we're facing the possibility here of, more of a correction that really could hurt stuff inside the market.
It's one of the indicators that perhaps internally things aren't all that great, is that margin debt has hit an all-time record high.
Well, the thing that's really curious about that is, it's quite amazing. I mean, it's a danger potentially, because when people are on margin, if the stock market drops, then they are forced to sell. They have no choice to sell. So that can add volatility to the downside, and then you have to wonder if people are borrowing money. There's a limit to how much they can borrow to buy stocks, and then, who's going to be buying. But one really curious thing about that is the margin debt made a new high around December, January, a record high, the amount of dollars on margin in the stock market. And, that's an alarming thing when it happens. But we just made a new high last month. But what's really curious about this is if you looked at past times when there are these surges in margin debt towards the end of a bull market, towards the very end of the bull market, you can often see a big jump in margin debt, and yet the stock market doesn't seem to really go up like it did in past jumps in margin debt. And that's exactly what is taking place now, or took place last month. Like I said when we started the interview, we're below where we were at the very first week of March. So people did all this buying of margin, and they're on a loss right now,
Are things in place now to stop a real fast collapse with automatic stop gaps that they didn't have in the past?
Well, I don't know if there's automatic stop gaps in the sense that the Fed or someone can just step in during the day to try to stop something. They can halt trading, and in fact, that's an automatic thing. If the Dow falls so many points, I think it's like 500 points or something, then they suspend trading for 15, 30 minutes and, try to hope that people will stop the selling. It had happened a couple times in 2008. But the Fed can step in, and in the past we've seen them lower interest rates to try to stop bear markets. They did that in the 2000 to 2003 bear market. There are several times where Alan Greenspan would do these sudden, bolt out of the blue interest rate cuts to try to stop that bear market, and it didn't stop it. It just, the market would rally, for a few hours after he did it, and then just keep dropping. And then in the last bear market, of course, we saw interest rates go to zero, and there was a few times where they did the same sort of thing, a bolt out of the blue rate cut. And to tell you the truth, one of those rate cuts it did save the stock market in January of 2008. There was a Martin Luther King Day weekend where our markets were closed. The markets overseas were down almost 10% in Europe across the board, and the Dow was poised to gap down 1,000 points. And before the open on Tuesday, Bernanke lowered rates by 75 points, emergency rate cut, and that stopped the gap down. It made the market actually rally for a few weeks, but it didn't stop that bear market, and the whole damn thing crashed in the fall of 2008. And they even banned short selling. They did everything they could possibly do, and they could not stop that bear market. So if we do see another bear market, which I do think is in the cards, I'm certain we will see the Fed come out or the government come out and do things to try to stop it, try to create a new bull market. They may create more quantitative easing money printing operations. For example, in fact, in the fall of of last year, in October, there was just a little drop of not even 10% on the Dow, and the Fed officials spread rumors via CNBC and Steve Leisman, using him as their mouthpiece, they had him get on there and say that he was talking to Fed officials that told him that if the correction were to continue, that they would do a QE, another QE operation, you know. And what has that done for our economy? Not much. I mean, there's no real recovery that's come out of it. It's, you know, created more debt on the balance sheet of the Federal Reserve, created a danger of inflation down the road, all sorts of imbalances that can, you know, just ruin the everyday man, but, you know, it's helped make the stock market go up. So the people over the past few years, the people in the market feel like they're rich because of that. And there is a belief, a widespread belief among investors in the stock market that the Fed will step in, that they will print money to save them and prevent another bear market, even if that means wrecking the entire country. So that's where we stand. Now, I would just say that, you know, if we get a bear market and then they're going to do this quantitative easing, in the 2003 bear market, lowering rates did not stop it. In the bear market after that, you know, lowering rates did not stop it. And if they can just say, well, we're just going to do quantitative easing to stop another bear market, well, how much will they have to print? You know, they had to lower rates to zero in the last bear market. Well, how much money are they going to print to try to stop the stock market from declining? And who cares if it drops 20 to 30%? It's not the end of the world. You know, market cycles are a part of investing. It's not, but that's, you know, we've created this culture of on Wall Street that, you know, they're willing to do anything to keep the stock market from dropping. And it's kind of bad for the rest of the country.
We'll have more with Mike Swanson right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, I know the theory is if you keep the stock market healthy, it's keeping the economy healthy. But nowadays, companies aren't investing in new jobs or new factories or new places to build product or put product out in North America. They do it around the world. So if you help the U.S. stock market, you're not really helping anybody locally, are you?
No, I mean, the theory is that, you know, that higher stock prices will make investors money, and lots of people own stocks, as not as many as people think. In fact, I was looking at a crazy article a few days ago showing that most people over 55 years old don't even have $1,000 of savings. That almost their entire net worth is in their home, and they don't really own many stocks. But, you know, the people listening to us, you know, a lot of them do, I'm sure. You know, people go to my website, they own stocks. But the thing is, the idea is when Bernanke created this quantitative easing program, he did kind of under criticism for it. And he wrote an editorial in the Washington Post in November the 4th, 2010, in which he justified it by stating that it will help people feel like they have money, more wealth, and then they'll go spend money and do stuff. So it wasn't just that it helps corporations out, but the individual in the stock market. But the problem is that it didn't really do that. Probably because people, you know, the statistics are the average American, even though the stock market went up as a whole, has lost assets since 2007. You know, say someone rode the market down and rode it back up. Well, they still had their house lose value. So very few people are really feeling like they're super rich or something just because the stock market's gone up. I mean, there are a few people like that, but it's just a very tiny proportion of the population. So it really hasn't done a good thing in stimulating consumer spending or the economy at all. And as far as the corporations go, I mean, they're not investing in, you know, as a whole. There's very little capital investment going on, and many of these corporations are going into debt by buying bonds or issuing bonds to simply buy more stock of their own, on the stock market to make it go up so the CEOs running these companies can have their stock options worth more. It's very short-sighted from, the health of the business or whatever, but, these CEOs running these things, they're short-sighted people. Nothing proves that more than the way they ran all these companies into the ground in the banks in 2007, 2008.
Well, I see in Canada, the head of Sears Canada does nothing but sell off their most valuable assets, so the share prices go up. But in the long run, what are they going to have to sell to customers? Nothing.
Well, you just wonder who the people running these companies. What's their real motivation? Most of these people did not start these companies that they're running. They're hired gun CEOs, and their life is the stock market and, making the share price go up. It's not like Henry Ford, inventing the Model T and really wanting to build a product that's going to change the world. It's just, these people are, it's just a different world these people live in.
Well, I noticed the statistics showed the average person had about a 2% pay raise last year, the average executive 17%.
Yeah. And the answer to all this, is they say, well, the shareholders should demand more. The shareholders should take their responsibility. Because in theory, the shareholders could, for any of these companies trading in the stock market, they could unite and kick some of these people out and say, well, we don't want this. We actually want you to run this company with profits in mind and then the next 10 years in mind and so forth, but the shareholders don't do that. And no one asks why they don't do that. I'll just say the answer why is because most of these shares are owned by money managers on Wall Street running mutual funds or investment advisors. Most of these money managers, institutional money managers, and they don't care about this stuff either. All they care about is the stock market going up too, so they want these guys to do anything to make their stocks go up for a couple months. And, someone running money, they may work there for 10 years, possibly 20, although that's the exception. So that's the longest time frame they have. And really they're just mostly obsessed over the quarter because that's how they're graded, is on their quarterly results. They're trying to beat the market over the quarter, and they want the stocks that they're buying to go up more in the stock market. And if the companies are buying back their stock and going in debt to make it happen, that's all good for them.
Is that where that margin debt is?
I think it's mixed up. It's probably, I don't actually, that's a really good question. I'm not sure. I'll have to look that up. But I would guess most of it's coming from hedge funds, not mutual funds. Now I know there are individuals, stock people, traders, or, just regular people on margin too. And now I don't know if anyone's ever broken down the exact proportions of all this, or if that data is even available. That's something I'll have to look that up and see if I can find out. But there was an interview I saw with the CEO of Ameritrade, one of the biggest online broker companies, and he was saying that out of the hundreds of thousands of people that have Ameritrade accounts, the small investors, small traders, that they were more fully invested and even on margin than they had been in almost 10 years. So, I could take his word for it. So I think it shows that there are lots of people all over the place doing it.
As part of that, people are impatient and they want to see big returns quickly?
Yeah, and most time, I've done it. I'm not on margin now, and I'm not likely to get on it, but I used to be someone, like 10, 15 years ago that would trade on margin quite a bit. And I found I would do it when I had gains to gamble with, let's say. So I think that's probably what's happened is because the stock market has gone up, these people that are going on margin, they think they're risking the gains they've already made, and they're getting very greedy and trying to pyramid up, so to speak. And, I know what it's like to do that. And, when things turn against you, you've got to get out immediately because you can lose so quickly the more margin you're on. So it'll be interesting to see, once that margin debt stops the trend of going up every month and starts to go down. And, if you look at the chart of it over the past 20 years, the peaks in margin debt have coincided with major tops in the stock market. And, I don't think that's a coincidence.
McDonald's says it's going to stop reporting monthly sales. Is that because their monthly sales haven't been that great the past year? Yeah,
that's exactly right. And it's kind of crazy. But it's not just them. It's actually a bunch of restaurants, too, that had decided not to report that information on a month-to-month basis. And really, to go back to kind of what we were saying before about, the time frame these people look out into the future, really a month-to-month results shouldn't even really be that important. I mean, if their sales are down in 1 month, it doesn't necessarily mean anything. But because the way the news is so short-term focused, they've had like 10 straight months of declining sales. They just said, we're going to stop reporting it altogether.
Yeah, no news is good news.
Yeah. Yeah, actually, I kind of think it is. You just turn it off, your life's a lot better,
Mike, thanks a lot for chatting with us.
Thank you. It's good talking with you as always.
My guest is Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.